Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about USA Compression Partners LP annual report. USA Compression Partners LP offers a wide range of businesses and services to various clients in the natural gas industry. The company provides compression services to oil companies, independent producers, processors, gatherers, and transporters of natural gas and crude oil. This includes infrastructure applications, such as centralized natural gas gathering systems and processing facilities. In addition to compression services, USA Compression Partners also offers equipment ownership and operation for natural gas treating services. These services include carbon dioxide and hydrogen sulfide removal, as well as natural gas cooling and dehydration. The company's fleet of equipment is substantial, with 3.9 million horsepower in operation as of December 31, 2025. The company's services cater to various clients in the midstream industry, including natural gas producers and companies involved in processing and transportation. With its extensive fleet and range of services, USA Compression Partners has established itself as a key player in the natural gas compression market. The USA Compression Partners LP USAC stock price has shown minimal significant change over the past year, fluctuating within a narrow range. Several factors contribute to this stability, including routine operational updates that are often within analyst expectations and do not significantly alter the company's long-term outlook or earnings forecasts. Routine business operations, such as consistent quarterly distributions, have been maintained at $0 and 525 cents per common unit throughout 2025 and into 2026. These announcements confirm income reliability for investors, but often do not cause significant immediate price changes unless there is an unexpected alteration to the distribution. The broader energy sector stability also plays a role in USAC stock performance. Periods of stable natural gas demand, supply forecasts, or infrastructure development news that align with expectations may lead to muted stock movements. The lack of major corporate announcements, such as large acquisitions or leadership changes, often results in the stock trading within a narrow range. The absence of major market-moving news and routine business operations that align with investor expectations are likely contributing factors to USAC's relatively stable stock price over the past year. Additionally, the broader stability inherent in certain MLP investments, which are often valued for their distributions rather than rapid growth, may also contribute to this stability. USA Compression Partners LP maintains a market capitalization of $3 billion, broadly in line with the industry peer group. USA Compression Partners LP trades at a higher price-to-earnings ratio of 33 times and a lower price-to-book ratio of -21.59 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 99% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 7.95%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the industry can be summarized into several key factors. Revenue growth is primarily driven by an increase in horsepower units on order, the addition of new customers and equipment from acquisitions, increased compression run times, reduced operating costs for customers, growing demand for natural gas and crude oil services, and expansion into new areas. These factors have contributed to a significant boost in revenue. On the other hand, revenue decline is largely attributed to reduced demand for natural gas and crude oil, low commodity prices, increased competition from well-resourced competitors, vertical integration by customers, and loss of key customers. These factors have had a negative impact on revenue. Additionally, external factors such as changes in climate and weather patterns, regulations, and legislation related to environmental concerns, and availability of funding for the energy sector also play a role in shaping the industry's revenue growth or decline. Net income experienced fluctuations between 2024 and 2025. Initially, it increased by $11.80% from $99,575 to $111,319. However, this growth was followed by a significant decrease of approximately $30.3 million due to imputed underpayment computations from an IRS examination. Despite the initial increase, net income ultimately rose by $31.6 million. Profit margins also underwent changes during this period. Gross margin decreased slightly from 39.2% in 2024 to 38.6% in 2025. On the other hand, adjusted EBITDA margin remained relatively stable at 67.3% in 2024 and 67.1% in 2025. The reasons behind these changes are multifaceted. The impairment of identifiable intangible assets due to reduced demand for services and long-lived assets due to industry changes contributed to the fluctuations. Additionally, uncertainty surrounding U.S. trade policies, including tariffs and trade agreements, may have had an impact. Furthermore, the conversion of preferred units to common units in June and December 2025 likely influenced net income and profit margins. The company's financial performance indicates a significant trend of generating positive operating cash flow. This is evident in multiple sections of the report, including page 37, where it explicitly states, "Yes" to positive operating cash flow. Furthermore, this trend is consistently confirmed across various pages, such as 43, 45, 48, and 50. The consistency of this data suggests a stable financial foundation for the company, allowing it to cover its operational expenses without relying on external funding sources. The company's debt level and interest expenses have undergone significant changes over the past year. According to the provided summaries, the total debt as of December 31, 2025, increased from $795 million to $1.3 billion between February 12, 2026, indicating a substantial rise in debt levels. However, there are mixed signals regarding interest expenses. On one hand, interest expense decreased by -3.1%, $6.063 million, and interest expense, net decreased by $6.1 million, 2025 versus 2024. Additionally, non-cash interest expense decreased from $8,748,000 to $8,554,000. On the other hand, interest payments increased by $27 million due to timing of payments related to Senior Notes 2026 refinance. Furthermore, total secured indebtedness has increased significantly, and the redemption of Senior Notes 2027 and the issuance of new notes with different interest rates have changed interest expenses. Overall, while there are some decreases in interest expenses, the overall trend suggests that the company's debt level and interest expenses have not decreased significantly. Management is optimistic about the company's outlook, citing opportunities for growth in compression services due to increasing production volumes. They plan to expand operations through strategic acquisitions, such as the JW Power acquisition, and continue providing reliable and flexible services in attractive geographic areas. The company expects to maintain stable cash flows through fixed-fee contracts and selectively add remote monitoring systems to optimize performance. Management also anticipates an increase in associated natural gas production volumes, leading to higher demand for compression services and increased fleet utilization rates. To drive growth, the company will continue to invest in capital expenditures, including financing the purchase of additional compression units and making other strategic investments. They plan to fund operations through 2026 using cash generated by operating activities and borrowings under the credit agreement, with external financing sources available for future expansion capital expenditures or acquisitions. Management is committed to maintaining a strong balance sheet, with a credit facility providing up to $1.75 billion in available borrowings. They also prioritize attracting and retaining top talent through competitive compensation packages, with executive officers motivated to achieve strong financial and operational performance. The company has made several strategic acquisitions to expand its operations and capabilities. The most notable acquisition is the JW Power acquisition, which was completed on January 12, 2026 for $860 million. This deal added approximately 0.8 million active horsepower and 1 million total horsepower to the fleet. Additionally, the company acquired specialized manufacturing facilities for the manufacture of compression units and 2 manufacturing facilities in Texas for the fabrication of compression units. The company has also made divestitures as part of its strategic planning. In recent years, it has sold a significant number of compression and treating units, including 28 units in 2025, 2 units in 2024, and 42 units in 2023. These transactions demonstrate the company's efforts to optimize its portfolio and focus on core operations. The company's financial history reveals a consistent practice of distributing profits to its shareholders through dividend payments. As stated in the official records on page 86, Energy Transfer LP has indeed paid dividends, indicating a commitment to rewarding its investors with a share of the company's earnings. This demonstrates a responsible and shareholder-focused approach to corporate governance. Supply chain concerns loom large for companies. The extracted summaries reveal several concerns regarding supply chain disruption that could potentially harm businesses. One major issue is the extended lead times for critical components, such as Caterpillar engines and aerial compressor frames, which have increased to over 2 years in some cases. This prolonged wait time can severely impact production schedules and overall business operations. Furthermore, companies are often reliant on a limited number of suppliers, making them vulnerable to product shortages and price increases. Geopolitical events can exacerbate these issues, causing disruptions that may harm suppliers and complicate existing supply chain constraints. The risk of non-performance by critical suppliers or vendors is also a concern, as it could raise costs or interfere with business operations. In addition, the implementation of complex systems, such as shared services models, can be time-consuming and prone to disruptions. These issues can have a material adverse impact on businesses, highlighting the need for careful planning and risk management in supply chain operations. That concludes the financial summary for USA Compression Partners LP. Feel free to comment below, and I will be happy to answer them when possible.